It's been more than a decade since the market faced a truly devastating correction. In that time, optimism has hardened into overconfidence, leverage has replaced discipline, and investors have forgotten just how quickly safe can turn into shattered prices keep climbing. Narratives like AI keep fueling belief. And the longer it goes on, the more people convince themselves this is normal, that the cycle has been broken. But cycles don't break. They bend, they stretch, and then, eventually, they snap. And that's exactly why Howard Marks, one of the most respected voices in investing, has stepped forward with a chilling warning. This has always been the pattern. For as long as we've had trade, markets, and money, human behavior has repeated the same cycle. Every market cycle tells the same story: a period of growth, a wave of excitement, then euphoria where risk is ignored and prices detach from reality. This has always been the pattern. For as long as we've had trade, markets, and money, human behavior has repeated the same cycle. And that's why Howard says,
that creates bubbles, and we probably in the early days of that.
to understand why this moment matters, you first need to understand the man behind the message. Howard Marks is not your typical Wall Street figure. He's not on CNBC every other week. He doesn't chase likes or headlines. But within elite investing circles, his memos are treated like gold. He's the co-founder of Oaktree Capital, a firm managing hundreds of billions of dollars, with clients ranging from pension funds to sovereign wealth. But it's not just the size of his portfolio that matters. It's the consistency of his thinking. Warren Buffett once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something. Why? Because Marks has a track record of identifying major inflection points before the crowd. He warned about the internet bubble in the late 90s. He called out overconfidence in subprime lending before the 2008 collapse. And in March of 2020, when the world was in full-blown panic, he wrote a memo titled "Nobody Knows," calmly reminding investors of the dangers of certainty. Marks doesn't just react, he anticipates, and he does it through a deep understanding of cycles, psychology, and value. So when someone like this starts trimming risk, stepping out of crowded trades, and building defense, you don't ignore it. Because the question isn't, is Howard Marks right this time? The better question is, can you afford to bet that he's wrong? His memos, which he's been publishing for decades, aren't just market commentary. They're masterclasses in thought process. He writes about risk when others are obsessed with reward. He talks about cycles when others are fixated on momentum. And he urges humility at the very moments when overconfidence feels easiest. More importantly, he doesn't just write, he acts. His portfolio moves are a reflection of deep conviction, not noise. And while you may not have billions to manage or a team of analysts at your fingertips, you do have access to something just as valuable: the framework, the mindset. And that's what this video is really about, decoding Howard Marks's thinking so you can make smarter, calmer, more strategic decisions before the storm, not during it. Early this year, Howard Marks released one of his most subtly urgent memos yet. It's called On Bubble Watch, and while the title may sound light, the message inside is anything but. The entire memo is a meditation on risk and the psychology of markets when optimism runs too high for too long. Here's the central idea. Investors have forgotten what pain feels like. Why? Because it's been over a decade since the market has delivered any sustained correction. People believe that tech will always rise, that interest rates don't matter, that momentum will always outperform value. And that's the problem. Because when a long enough period passes without pain, investors start assuming pain is gone for good. They confuse good times with permanent truths. They extrapolate. They stretch the present into the future like it's a rule. And as Marx says, that's the single biggest mistake investors make.
The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. And and you know, I just think that the fluctuations of the market are mostly related to psychological fluctuations, uh, and uh, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much, and that's the continuation that creates bubbles. And we probably in the early days of that.
And he's not just talking theory. He's talking about history and how human nature repeats. When people have only seen uptrends, they assume it's the default. They stop asking what something is worth and start focusing only on what price it might hit next. That's why Marx is pushing back. Not with panic, not with predictions, but with pattern recognition. He's saying, don't get lulled into thinking the sky is the limit, because the sky always seems limitless right before the clouds roll in. In his most recent memos, including the calculus of value, he stresses how dangerous it is to stretch the present forward. Just because growth stocks dominated the last 5 years doesn't mean they'll lead forever. Just because risk was rewarded yesterday doesn't mean it won't be punished tomorrow. It's not about timing the top. It's about recognizing that you're climbing higher, and the ground hasn't moved. In fact, if there's one thing Marx keeps returning to, it's this idea of cycles. He doesn't believe in straight lines. He believes in tides. What goes up eventually comes down. And the question is never if, only when. On Bubble Watch, he doesn't just say prices are high. He says sentiment is creeping into the danger zone. Investors are no longer neutral. They're euphoric. They're chasing. And they're forgetting how markets actually work. The quote he anchors much of the memo around is this: "He who knows only his own side of the case knows little of that." In other words, if you can't argue against your own optimism, you probably don't understand the risks. And if you don't understand the risks, you're not investing. You're just hoping. Marx wants investors to stop hoping and start thinking. Start reassessing. Ask, what if I'm wrong? Because when everyone's thinking the same way, the edge disappears. He even breaks down both sides of the current bull case, citing strong earnings, AI tailwinds, and economic resilience. He gets it. But then these positives don't erase valuations. They don't offset concentration risk. They don't justify abandoning discipline. This isn't about selling everything. It's not about panic or exit signs. It's about one thing: preparation. Because if this is the beginning of a bubble, not the end, the time to adjust isn't after the cracks appear. It's while everyone still feels safe. Now, here's where things get even more real, because it's not just what Howard Marks is saying in his memos. It's what he's actually doing with billions of dollars that tells the deeper story. His most recent 13F filing for the second quarter of 2025 reveals some striking moves, and they paint a picture of defense, repositioning, and a quiet retreat from risk. Let's start with the biggest changes. Marx completely exited some well-known names in China tech. His stakes in JD.com, Baidu, Bilibili, and Kingsoft Cloud all sold down to zero. He also fully dumped Petroleo, H World Group, Vacasa, Onity, and DQ New Energy ADR. That's a sweeping exit from a mix of emerging market plays and speculative growth. But it's not just what he sold, it's what he bought. Instead of chasing momentum in tech or AI, Marx was building exposure to defensive, cash-generating assets. His biggest new positions include Bausch plus Lomb, Full Truck Alliance, Liberty Lilac Group, YPF Argentina's energy giant, and Hudson Technologies. These aren't moonshot companies. They're steady, cash flow-driven businesses that tend to survive turbulence better than hype-driven growth stocks. He also boosted stakes in resource-heavy plays like Itaú Unibanco, up 58%, adding more than 4 million shares. Canzun, up 34%, adding around 400,000 shares. Barrick Gold, up 25%, adding more than 600,000 shares. And KE Holdings, up 20%. In other words, he's leaning into banks, miners, and energy producers, companies tied to real assets and real cash flows. Meanwhile, on the other side of the ledger, he slashed exposure to some of his biggest positions. Vail was cut by 2/3, down 66%, TGS Transportadora by more than 70%, Banco Macro by more than 76%, and Braskem, an industrial name, by over 80%. Even Star Bulk Carriers was reduced by nearly 40%. What does this all mean? It means Marks is rotating away from risk-heavy cyclicals, speculative growth, and crowded foreign bets, and doubling down on resource-backed defensive cash generators. And when you zoom out, the picture becomes crystal clear. Oaktree's equity sleeve, which is already a modest part of its total assets, just became even more conservative. What these moves mean, if the market stays strong, fine. He collects dividends and stays safe. But if things reverse, he'll be holding assets that survive downturns. If this all feels familiar, that's because it is. In the late 1990s, the market was electric. Tech stocks were booming. Valuations were climbing. And the S&P seemed unstoppable. Investors weren't cautious. They were euphoric. Howard Marks remembers that time vividly. In fact, in his recent interviews, he explicitly referenced it, not as a one-to-one comparison, but as a psychological similarity. Back then, Alan Greenspan warned of irrational exuberance, but the market didn't collapse right away. It kept rising for another 3 years. That's why Marks says, we may not be in a full-blown bubble yet, but we could be in the early days of one. Because the pattern is clear. Investor psychology moves in cycles. It begins with neutrality, then optimism, then excitement, and finally, euphoria. And every time we reach that final stage, people say, this time is different. Marks isn't saying the market is doomed tomorrow. He's saying the conditions are being set. Valuations are stretched. Optimism is high. Concentration is back. And historical indicators, from the CAPE ratio to market cap to GDP, are all flashing yellow, just like they did in 2000, 2007, and 2021. And that's not fear-mongering. It's memory. And memory, combined with pattern recognition, is what makes Marks so cautious right now. During the dot-com bubble, investors weren't worried about profits. They were chasing eyeballs, clicks, and future potential. Sound familiar? Today's excitement around artificial intelligence, tech platforms, and software margins mirrors that same type of hope-based investing. Here is what he has to say about this.
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise. And they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think is more alarming than the fact that exceptional valuations are being applied to exceptional companies.
That's a major signal. While the Magnificent Seven are strong companies, what's more concerning is the high valuations being applied to average companies. That's the real similarity of the past, not just the stars, but the supporting cast getting overhyped. In every past market peak, it wasn't just Apple or Microsoft leading the charge, it was everyone else, being pulled along for the ride. Marks sees that ride beginning again. And this time, the risks may be even greater. Back in the dot-com days, interest rates were falling. Today, we're coming off a period of aggressive tightening. Back then, the Fed had room to cut. Now, inflation is reluctant. The margin for error? Much thinner. And yet, investors feel invincible. Passive flows keep pushing markets higher. AI narratives fuel expectations. And bubbles don't form when people are scared. They form when people feel safe. Marks sees that safety turning into complacency, and his message is simple. The music hasn't stopped yet, but the tempo has changed. Don't mistake silence for safety. Because if the past teaches us anything, it's that euphoria always feels like logic, right before it breaks. Let's zoom out. Because all of this, The memos, the moves, the market talk. It's not just about billionaires shifting capital. It's about mindset. Howard Marks has spent decades thinking about cycles, risk, and positioning. And what he teaches us, whether he means to or not, is that survival in investing comes from preparation, not prediction. So, what can you do? First, you don't need to sell everything, but you might want to start asking tougher questions about your portfolio. Are you concentrated in just a few stocks? Are you leaning too hard into growth narratives? Are you investing based on what's worked recently or what's sustainable over the next decade? Marx isn't telling you to panic. He's suggesting that you pause, that you don't let past gains convince you they'll continue forever, that you think defensively, even when things still feel good. Maybe that means adding some fixed income. Maybe it means trimming your riskiest positions. Maybe it just means building a little more cash so you're ready when others aren't. But mostly, it means being honest with yourself. Because the next 10 years probably won't look like the last 10. And Marx knows that better than most. Because when you look back at every major downturn, whether it was the dot-com collapse, the financial crisis, or even the brief but violent drop of 2020, the people who came out ahead weren't the ones who predicted the crash. They were the ones who prepared. They had dry powder. They avoided the hype. They stayed focused on quality. And they didn't let their emotions dictate their decisions. That's the playbook. Howard Marks calls it second-level thinking. While most people ask, what's hot right now? Second-level thinkers ask, what's already priced in? What's likely to go wrong? And am I ready for that? So as you look at your own investments, ask yourself, are you prepared for a market that underdelivers? Are you building toward returns or just hoping for them? Because hope isn't a strategy, but preparation. That's how the best investors do it. And if you follow Mark's lead, not his trades, but his thinking, you might find that the next downturn becomes your biggest opportunity. We saw Howard on a selling spree, but he is not the only one. Buffett's recent 13F filing shows he sold over $6 billion worth of stocks. Click the video on screen to know what and why.